First of all, let's just ask the broad question, which is, what did you make of the Fed minutes and what did they inform you?
Well, first of all, good morning, and thank you for having me on your show. I think the Fed minutes were pretty much as expected. People expected that there would be a signal that there was likely to be a rate hike coming in March. We certainly do expect that. The Fed also cited the fact that labor markets are very, very strong and that inflation is well above target. Probably what's lacking, though, for a lot of people in terms of clarity is if the Fed will do a 25 basis point rate hike or a 50 basis point rate hike. I think what the Fed alluded to in their minutes is that it's probably likely that they do more of a 25 basis point rate hike. And the reason that is that they believe that if they did 50, it might tighten financial conditions too much if they start off with a 50 basis point rate hike. The markets are very, very undecided on this. I think it's a toss of a coin to see which one they do. I think the markets can handle a 50 basis point rate hike, but this is something that's going to need to be made more clear. But people are taking away from this that it's likely that the Fed hikes 7 times this year, which gives them, 125 basis point rate hike every single meeting for the entire year. That's what many forecasters are saying today.
Jim, give me a sense of where we are with the Federal Reserve, as they say that they are, of course, data dependent. Now, you say in your notes that you can't manage what you can't measure. Surely the data will tell us that.
It surely will. The problem with this is that it's going to take time. So one of the things that the Fed is trying to measure is inflation, and they've been very wrong about it. So the view is that inflation will start to decline starting in the second quarter. But the problem is that we may not get second quarter data really until May. That's when we start to see April data. And in June, we see data for May. So really throughout the second quarter, that's going to be the period where the Fed is starting to watch to see if inflation is in fact rolling over, and also throughout the course of the year to see if inflation's coming down fast enough. Now, there are a lot of pressures on the Fed, even from a political perspective, to try to get inflation down and under control. So the issue that we have here is one of timing, that it's going to take at least another quarter before we get better clarity on measuring inflation.
So, Jim, the key variable is inflation, whether it eases from here or not. How is that playing out in the way you look at asset valuations in the year ahead? What is looking attractive to you?
So what looks attractive to us right now, just because we think that rates are going up. In the first instance, we would argue that assets like bank loans, for example, which are shorter duration, floating rate, high yield type loans. This is an asset class that we still think has some value in it. It's trading below par. It's a senior secured type of an investment to buy. So that's going to be something that gives us some enhanced yield, but also some rate protection, as interest rates rise. The second thing that starts to look very interesting to us, this is more value orientated, but we like local emerging market debt. And the reason that we do is that many emerging markets have already started hiking interest rates very, very quickly and by a substantial amount last year. So we think that many emerging markets are already later in their rate hiking cycle. Some of these markets have the highest real yields and certainly the highest yields per unit of duration and also per unit of credit quality. So we think that, yes, we need to be defensive in fixed income to protect against higher rates, but we can't forget that we can also play some offense too. There are things that are still valuable and places to make money. Emerging market local rates is one of those, and also floating rate high yield assets like bank loans are another.
But Jim, the EM space is a huge universe. Where exactly in EM do you park your money?
Yeah, so this is the whole thing, and I think that's a very, very good point. So one of the things that we look for is, in terms of the global cycle, commodity prices are moving higher. So we start to look for commodity exporters, and we also start to run a screen on countries with good terms of trade, and also countries whose central banks have already started hiking rates quite aggressively going forward, quite aggressively in 2021. So this would suggest that, some markets, like, for example, South Africa might be one of those, that we would look at, even places like Brazil, where the rate hiking cycle has been very aggressive, even other places like Central Eastern Europe, like, the Polands, the Hungaries, the Czech Republics, where we believe they're getting later in their rate hiking cycles. And we still believe that, as inflation starts to peak in the second quarter, that many of these rate hikes that these central banks are talking about may not actually start to come through. But we think it's a little bit early. So what we would suggest is cost averaging into some of these investments and not doing it all at once, because we clearly don't know what the interest rate picture is in the US. That still has to play out.
Jim, the first two countries you mentioned were South Africa and Brazil. Of course, they've had a terrible performance in their currencies. Now, when you look at emerging market local debt, then you have to take into account what happens with the trajectory of the dollar, and how do you hedge against perhaps further appreciation of the dollar and a decline in those local currencies?
Yeah, that's exactly correct. So in some cases, you can hedge out the dollar risk, and you can just take the local bond market exposure. But as far as the dollar goes, what we would expect is that the dollar starts to actually weaken. What we've seen historically is that the dollar tends to strengthen right up to the start of the rate hiking cycle, because that's when the most is priced into the forward interest rate curve in terms of what the Fed may actually do. And that's typically where the dollar is the strongest. So that's right around now. That's right around here. So going from now until mid-March. But from mid-March onward, what we would start to expect is to see a tightening of financial conditions in the U.S., which would mean that might weigh on U.S. asset prices a little bit, and that many of the asset prices in some of these local emerging markets, will actually start to appreciate, and essentially that could drive flows out of the dollar and into some of these emerging market FX currencies and also countries. So inherent in our view is that we do think that there will be a slight weakening of the dollar. And that's certainly already happening. We're already seeing this play out right now. Local emerging markets, if we look at the indices on this, local emerging markets are up almost 1.5% year to date. So it's a bond market that's actually producing a positive return. The dollar's a little bit stronger, but we think that's going to happen a little bit later on.